I am pleased to introduce you to Sri Nitin Potdar. Sri Nitin Potdar heads the M&A practice of J. Sagar and Associate Advocates and Solicitor. He specializes in public and private merger and acquisition, including demergers, restructuring of business, assets and share purchase deals, JVs and strategic alliances, private equity and general corporate advisory. He has vast experience with transitions related to FDI and exchange control regulation. He has advised several multinational companies on financial and technical collaboration in India and strategy option for commencing operation and consolidation in India in a cross-section of industries. He has been a part of several high-profile corporate takeovers battles, including defending hostile bids. He also has extensive experience in private equity transaction, including leverage buyout, transaction and exits. He has provided strategic and business-oriented advice to a variety of companies receiving private equity investment. Prior to joining J. Sagar and Associate, he was a partner for 6 years with Amarchand and Mangaldas and Suresh Isrop and Company, prior to which he worked with Copper Valley and Company as a senior associate. He is a frequent speaker at several conferences and seminars organized by leading industry institutions and chambers on subjects like takeover board, M&A and structuring of JVs. He was a member of International Bar Association, Antitrust Section and India Advisory Group. Currently, he is a member of Executive Committee of Maharashtra Chamber of Commerce and a member of Managing Council of Chamber of Tax Consultants. With this introduction, now I request past President Sri Sujal Shah, President of Memento, Sri Nitin Potdar. May I now request Sri Nitin Potdar to start his presentation.
1 minute, right? Generally, the person who will Memento will not speak about the speaker because the introduction is already done. But being a very good friend, let me also tell some of the things which are not read out. Nitin is one solicitor I have found amongst very few who understands commercials also extremely well apart from the law. So that combination maybe is a reason why he is considered in among the one of the top M&A solicitors in the country. And another thing about Nitin Bhai, whatever he takes up with a great passion, whether it is a charitable work or it is something to do with his client's work. He has a huge amount of passion and I have to learn a lot of things from him. So these are the things which of course are not mentioned in his biodata, but truly inspiring for all of us as a profession.
Friends, thank you very much, Sujal bhai, for your kind words. Thank you, Yatin, for the introduction, and Nitesh for the detailed introduction. Firstly, friends, I'm extremely sorry for the slight delay that has happened, and again, honestly, that is because of the entire country being under construction. So, whichever part of the country you go, I'm talking of country, whichever part you go, you will find roads, you will find bridges, you will find, not that they are in the final shape, but they are under construction. And one of the sentences recently I read in one of the very good book on inspiration. They said road of progress is always under construction. So we can assume and be happy of the fact that the country is under construction and we are progressing. Friends, I understand that for a couple of weeks we have been taking, the chamber has been taking the sessions on Companies Act. So there are 1 or 2 slides which I have put. I believe that those also sections must have been covered, but I thought that in addition to the M&A, I must take those, at least speak out on those few sections. Normally I don't do it, but today I would like to do that. A very clear-cut disclaimer that I am also learning like you. We have learned Companies Act. I started my practice in '89. So sometime in '87, '88, I have learned the Companies Act. Thereafter in 1990 and '91, when I was going through my solicitor's exam. At that time, the Companies Act we studied in detail. So I studied Companies Act in detail. '92 came SEBI, and thereafter we all have been learning takeover code, insider regulations, FIS. From '91 we have been learning the FDI regulations in bits and pieces as it evolved. We have seen the transition from FERA to FEMA. We have seen the MRTP going and sees the Competition Act coming in. So we have seen a lot of transition. Probably for my batch, this would be the this would be probably the last transition on Companies Act. I believe. We will not survive thereafter. Honestly speaking, I have two ways of generalizing or mentioning my views about the Companies Act. I don't want to be critical because now it is part of our life, so we can't criticize it. And I will not do that. So there is enough to criticize. But now let's accept the fact that Companies Act is going to be our part and parcel of our life. And we have to live with this for the next couple of years till such time it is changed or whatever happens. When I look at the Companies Act as such, and when I want to compare it, when I objectively try to find out what exactly has the new Companies Act done, I compare it with, on a lighter vein, in our Marathi literature, there is a writer called P.L. Deshpande. Pula Deshpande, I know many of you know. Many of you may know. Pula Deshpande had written a small story on Panwala. The Panwala where we get pan. He compares the old Panwala with the new Panwala. So he says that the historical Panwala was where he feels his that pan his office or wherever he operates from, it's so nicely decorated with all his bottles and everything nicely polished. He also will be in that white jacket and with tikka and everything. So you will feel different, completely pleased to see that Panwala, and you will also feel pleased to go and eat that pan. That was historical Panwala. It's typical Panwala. Now if you compare that with the recent Panwalas in the last 15-20 years, you will find these Panwalas are outside the South Indian restaurant, who will sell cigarettes, who will sell medicine, who will sell postcards, who will sell everything other than the pan. You won't get the typical pan from this Panwala. You will get everything else. Now I compare the old Companies Act with this new Companies Act. The old Companies Act 1956 was a marvelous and a fantastic piece of legislation. If you go to the history of every section, and you will see that it is so thoughtfully done. Every section, believe me, every section was so thoughtfully written. The writing is so beautiful of every section. The evolution, the sequencing of those sections was so brilliantly done. Because it was honest to the corporate, to the company as such. Because that law is honest and sincere to the corporate act, the corporate company act, company as a whole, as an entity. When you see the new Companies Act, we feel that we think that it is easy. But what has it tried to do? It has tried to bridge gaps or be a bridge between SEBI, between ROC, between income tax, between competition commission, between stock exchange, between minority shareholders, investors, stakeholders. Everywhere it's tried to bridge up the gap. One more comparison I would give, that will make the life easy for us to understand what Companies Act is. If you see the Golden Bridge, the Golden Bridge of US, compare that bridge vis-a-vis the multiple cross bridges which you see in Japan. So this law, this new Companies Act has tried to sort of create bridges or try to connect the dots between various laws and various requirements. The prime focus seems to be that let's find out where there is fraud. Prime driver of this law was find out where can it be misused. Find out what can be done for minority shareholders. Find out how to avoid, misstatements or governance issues. So it is more from, it's more of I would say a patchwork to patch up the mistakes or patch up the offences which have been committed in this last couple of years. With this, friends, brief introduction, let me just take through a couple of slides. I may not elaborate, we'll just go through it quickly. Companies Act was notified, as you know, on 30th. I will not spend too much time on this. To say that the old Companies Act has served us for 57 years. In 1991, FDI policy was introduced. Major changes were brought in. Liberalization, globalization, rise of information technology have transformed the manner in which business has been done globally. New businesses including IT, service sector, IT, telecommunications, banking, insurance, all this emerged. Volumes of companies, firms increased multifold. Increase of FDI, joint ventures, foreign collaborations, mergers, capital raising through ADR, GDR, FCCB. Increase of scams, frauds, minority protection, lack of corporate governance. Considering all this background, there was a need for the new Companies Act. The first concept paper was issued in August 2004, and thereafter we have seen the way the new Companies Act will have been progressed, and finally we have seen it being gazetted in 2013. Now, the serious challenges, friends. One is, what would happen to the settled jurisprudence under the 1956 Acts? To my mind, it will only have a persuasive value. It will have persuasive value. So for some time, we will have to go back to the basic concepts of the Companies Act. Just to take you a very live example is definition of an undertaking. I think section 180 talks of transfer of undertaking. You need permission from shareholders in case it is a substantial undertaking. Now there are two qualifications to that section, but still the basic base remains in what is an undertaking. So for that we have to go back to the decisions of the various high courts. There are on number of sections, there are beautiful judgments. There are jurisprudence is got beautifully developed, and that we cannot give up. But unfortunately, it will only have a persuasive value. So at times we have to go back to those judgments and see whether those judgments are still relevant and to what extent we can interpret. So there will be a transition phase. Now, in the next couple of years, we will have to struggle with the old act. I mean, we will have to take out the judgments under the old act, because the new act there is no jurisprudence. We have to develop. So some time will go, friends, in developing that jurisprudence. Uncertainty and excessive delegation of powers. Now, if you see the new Companies Act, again, I don't wish to criticize, but at several places, wherever the lawmaker or legislature found that it is a difficult area where they can't write clear law, they have said this will be as per the rules prescribed. This will be as per the SEBI guidelines. This will be as the government will decide. So, around there are 300 matters. I have checked microscopically, but I will stand to correct it on this. There are around 300 areas where government have reserved the right to make rules. Now, in a way it is good, in a way it is bad. Now, see the first classic example of the CSR regulations. CSR modification, the regulations which have come on CSR, they have simply changed the schedule 6 or schedule 7. They have just simply in one sweep said, no, this is the new schedule, now get replaced. Now see, if this is going to happen, I have my own theory. I will really have to worry then as to what will be the final outcome. Similarly, SEBI will keep on coming with rules, regulations, ROC will come with rules and regulations. So that is going to be a bit of a challenge. I hope that at some point of time, like the FEMA regulations or like the FDI regulations, now government comes out with every year, in July they come out with one consolidated guideline. So similarly, MCA or someone will at least at some point of time think that look, at least if not every year, at least twice, once in 2 years or something, we'll consolidate all the changes and announce it once and for all. But otherwise, friends, it will go to be a nightmare for us to follow and find out the rules, regulations, clarifications, guidelines, or verbal communications, opinions. It will just keep floating and floating and floating, and there will be no end to that. Overlap of regulatory inconsistency, CCI, SEBI, needs to be addressed ASAP. Now, I will take you through when we go through the mergers, process of merger. There are overlapping provisions. There are timelines will overlap. Every regulator wants to have a say on merger and acquisition. As if the shareholder doesn't understand and as if the promoters are here to commit fraud on every transaction. Yes, there might have been cases where promoters may have taken advantage. I would assume that in substantial part of the majority of the cases, promoters or the persons in majority control would have taken advantage of the positions or situations. But that doesn't mean that every transaction need to be scrutinized by every regulator. Every transaction should be put into a dark, scanner. And the approach is slightly worrisome. So professional bodies, institutes, colleges, organizations will have to come forward to effective implementation. And this is a classic case what you all are doing and we all are doing. I think this should be a welcome step. I will not go to this because I understand, this has been taken care of, but couple of sections where I felt that I must express myself. The first change is the welcome change is the provision with regard to transferability of securities. If it is covered in the earlier section, then just tell me, I will skip it. Friend, this is one of the provisions which was bothering the corporate world ever since 1991, ever since the judgment of Rangarajan. In 1992, Supreme Court decided that the private agreement between two shareholders will not be binding unless that is in the articles of association. Now, since that time, it has taken us almost 20 years now to resolve this issue. So the first time in the New Companies Act, section 50, proviso to section 58 says, yes, if the two shareholders are free to decide the way they want to dispose the shares. So that freedom has been given for the first time, which was so simple. In 1991, when the foreign investment was announced, or the FDI regime when we adopted, at that time, government amended certain sections of FERA at that time. Government amended certain sections of MRTP. Certain sections of IDR Act was also amended. But unfortunately, the provisions on the Companies Act was not changed to suit joint ventures and foreign collaboration. So on one hand, in 1991, when we said that we will allow foreign investment in India, we just did not change the corporate structure, the basic premises of the Companies Act, knowing fully that every investment is going to come to India will be in the form of a company only, and no, it will not be in the form of a partnership or LLP at that time was not there. It will not be in the form of a partnership or proprietary or whatever. It is going to be in the form of a company. So certain provisions of the Companies Act will need some changes just to accommodate the structure of a joint venture we did not anticipate. So right of preemption, right of first refusal, put option, call option. Friends, you all know, last 20 years we have struggled with the interpretation saying that SEBI came at some point of time saying this is forward contract, bad, illegal, and they will throw out. But still 20 years corporates have been structuring, various forms. We have been issuing opinions on how put option, call option is valid, in what situation it is valid, in what situation it is not valid, pricing guidelines, and very recently then the government has come out with the guidelines in put option, call option is also valid, subject to RBI approval again on pricing, which RBI has again put a different spanner altogether, again leading to a lot of questions which are unanswered, whatever. But at least the Companies Act for the first time recognizes that a shareholder is entitled to dispose his shares the way he wants to dispose. So that's a good way of looking at it. Second provision is good provision of the Companies Act, is the entrenchment provision. You can now amend the Articles of Association and give some rigorous provisions over and above the Articles of Association or over and above the corporate law. You can make certain provisions more restrictive. That is what is being allowed now. Only time will say, and time will only prove how far this is valid or to what extent can we go on this. Corporate social responsibility has been introduced. It covers all companies, private. And I told yesterday was a detail, last week was a detail session, so I will not dwell upon that. Then there is a board composition also. There is a change in board composition. Now again, if you see, friends, the Schedule 4 of the Companies Act, which talks of the role of an independent director. If you really microscopically look, they have converted an independent director into a promoter. Because the independent director is supposed to evaluate the business plans. He is supposed to evaluate and react why the business plan has not been successful. is required to evaluate the packages, the salary packages for the employees of the management of the firm. How is that independent? For example, if I am a corporate lawyer, as an independent, if I sit on a pharmaceutical company, and if I sit on a FMCG company, if I sit on a textile company, how would I know that industry norms? How would I know what's happening in that industry? For example, you people as a standard company, if you sit as an independent, our skill set will be restricted only to the area of our expertise. But if you see the requirement of Schedule 4 is makes you virtually like a promoter. Now coming to the M&A provisions, that is covered in chapter 15 of the new. Again, unfortunately, it is still not being announced, not notified, probably because the entire process has to go to NCLT. The tribunal is not notified, therefore probably this is not notified. Friends, basic structure of compromise and arrangement has not been changed, thankfully. But the process is undergone change. There are a couple of interesting provisions, interesting process, interesting concepts which are built in. And as we go here, I'll take you through those concepts. Again, friends, it runs into a couple of sections. Unless you really see those sections in detail, you will not be able to get the hang of the sections. What I have tried to do is I have tried to pick up the important concepts from the new sections, and we'll discuss that. Again, friends, this is a first, very first interpretation. So, I am open to correction, and I am open to discussion on certain sections if required. And we have to wait and see how the law evolves on this. We have to wait and see how SEBI comes out with new regulations or guidelines. MCA how it looks into it. Basically, friends, 391, 394, 393, 394, those sections now are reflected in section 230 to 235 to 237 of the New Companies Act. The concept remains same, that like in 391, parallel to 391 is 230 of the New Companies Act. If you propose any reconstruction or compromise or arrangement between company on one hand and the creditors on the other hand, or if you propose any compromise or arrangement between company on one hand and the members on the other hand, you could propose a compromise or arrangement between these two categories of people. Similarly, under 394, when a scheme of compromise or arrangement is for the purpose of a merger or amalgamation, that also has to follow the same process. So nothing really changes. The concept of compromise and arrangement between company and members, or between company and creditors, or if a scheme of compromise or arrangement is in the form of an amalgamation or a merger between the two companies, the process remains same. Nothing changes. The basic concept remains same. So you apply for to the tribunal for convening meeting of the members or creditors, as the case may be. You need to submit the documents, the latest financial position, auditor's report, certificate of the company's auditor, confirming that the accounting treatment. I'll come to the accounting treatment little later. Disclosure with respect to pendency of an investigation, reduction of capital. So everything has to be declared to the shareholder by the application. Then the tribunal will allow the holding of the meeting. Most importantly, there was a lacuna in the old act, namely, whenever we propose a scheme of compromise or arrangement, question was always as to whether you need creditors meeting or not. And various high courts have took different views earlier. And in fact, there is a Delhi High Court judgment some time back, which very clearly says that there is a lacuna in the process of mergers and amalgamation, because it doesn't talk of a permission for or a meeting of the creditors. So for the first time, and the Delhi High Court had at that point of time in that judgment had expressed hope that the legislature will change over a period of time, and the legislature will think that it is necessary to have a creditors meeting also. what was the position and what was the controversy. Let me just briefly explain you. The law was silent. Section 391 is silent as to whether when you propose a scheme of compromise or arrangement between the company and the members, whether creditors' consent is required or not. So we used to go to the court, typically in the Bombay High Court, and we used to tell the court that look, this is the arrangement between the members of the company, creditors are unaffected. So court used to ask us, how do you say that creditors are unaffected? So we used to give a statement of our solvency. We used to say that look, despite the merger or amalgamation or compromise or arrangement, selling off, or whatever we may do, the creditors are secured. They are not financially in a bad shape. Now again, it was a subjective question always. So to overcome that, what did we do? We used to go to the creditors and take their consent. Not 100%, but substantial creditors we used to take permission and file an affidavit to the court saying that look, I have obtained substantial consent of these creditors and therefore please pass, whoever has not given the consent are small creditors, so don't worry about that, we'll take care of that. So this was the process. Now for the first time, notice has to be sent to all the creditors and to all members and debenture holders along with copy of the scheme, valuation report, report adopted by the directors. So the law has made first time a compulsory notice to all the creditors. Most importantly, the final change is this in the second part. The dispensation of the creditors meeting will happen only if we have 90% in value, the creditors holding 90% in value, giving their consent, and not only consent, but we have to obtain a confirmation from the confirmation to the proposed compromise or arrangement through an affidavit. So they will only, the creditors will have to 90% of in value has to approve and an affidavit to be filed that yes, no creditors will be prejudicially affected because of the scheme of merger or amalgamation. Now, one more interesting provision. Whenever we used to propose a scheme or arrangement or amalgamation, we used to give notice to the ROC. ROC's notice was deemed as a notice to all the